Central banks are running out of ammo. What happens next? For decades, central banks have been the mighty guardians of economic stability. With the power to print money, raise or cut interest rates, and inject liquidity into global markets, they've managed recessions, fought inflation, and kept economies afloat. But what happens when their tools no longer work? In recent years, the world's major central banks, the Federal Reserve, the European Central Bank, the Bank of Japan, have pushed their policies to the edge. Zero or even negative interest rates. Trillions in quantitative easing. Massive bailouts. And still, economies remain fragile, debt levels soar, and inflation refuses to behave. The ammo is running low. And the threats keep growing. Geopolitical instability, deglobalization, a fractured energy transition, and a growing divide between emerging and developed economies. As central banks face unprecedented challenges, one uncomfortable question looms large. What happens when the last bullet is fired? In this episode of Money Minded, we explore the limits of central bank power. From the failure of traditional monetary policy to the rising calls for fiscal dominance and even central bank digital currencies, CBDCs. We'll uncover what may come after the age of central bank omnipotence. Because make no mistake, when the world's financial firefighters run out of water, the fire doesn't wait. Stay with us. Chapter 1: The End of Traditional Tools. For most of modern economic history, central banks were seen as the guardians of prosperity. When crises struck, they acted swiftly, slashing interest rates, buying bonds, injecting liquidity. These tools, once thought nearly omnipotent, are today showing signs of exhaustion. Let's rewind to the global financial crisis of 2008. Faced with economic collapse, the Federal Reserve and other major central banks slashed rates to near zero. When that wasn't enough, they introduced something unprecedented: quantitative easing, QE. The idea was simple in theory: buy government and private assets to flood the system with money and lower long-term interest rates. In practice, it became a permanent feature. Trillions of dollars, euros, and yen were created. Fast forward to COVID-19. Governments locked down economies, and central banks went even further. More QE, corporate bond purchases, emergency lending facilities. The Bank of Japan owned half the ETF market. The ECB pushed interest rates below zero. The Fed added $4 trillion to its balance sheet in a single year. These actions were effective in the short term. Financial markets boomed. Unemployment was cushioned. A depression was avoided. But cracks started to form. Asset bubbles emerged in housing, tech stocks, and crypto. Inflation, which had been tame for a decade, came roaring back by 2021. It wasn't transitory, it was systemic. Central banks were trapped. Raise rates to tame inflation? Risk crushing over leveraged economies. Keep rates low? Let inflation spiral and damage purchasing power. They chose to hike. The Fed led with the fastest tightening cycle in decades. But this came at a cost: bank failures, SVB. First Republic, a tightening credit market, and debt servicing burdens on governments and consumers alike. Meanwhile, QE had lost its punch. Once a novelty, it became an addiction. Each round of QE did less than the last. Asset purchases inflated financial markets but did little for productivity or wages. In essence, the central bank toolkit is no longer fit for purpose. Interest rates can't go much higher without causing financial instability. QE is losing credibility. And forward guidance, a tool built on communication and trust, is faltering in a world of geopolitical uncertainty and declining institutional faith. As inflation and stagnation collide, the world faces a monetary policy paradox. The tools that once saved the economy may now be fueling its next crisis. The question is no longer just about what central banks can do. It's whether their core frameworks, built for a different era, still apply in today's fractured, multipolar, and high-debt world. When your toolbox is empty and your old maps no longer work, what comes next? That's what we explore next. Chapter 2: The Rise of Fiscal Dominance. The shift from monetary to fiscal power is perhaps the most underappreciated trend of our time. For decades, central banks operated independently, targeting inflation and financial stability while governments focused on spending and taxation. But that division is breaking down. In the wake of COVID-19, governments unleashed fiscal stimulus on a historic scale. From the US CARES Act to Europe's Recovery Fund, public deficits exploded. Central banks enabled this by keeping rates near zero and buying government debt. This wasn't coordination, it was convergence. This convergence has a name: fiscal dominance. It's when monetary policy is effectively dictated by fiscal needs. In simple terms, central banks must keep borrowing costs low to prevent government insolvency, regardless of inflation. This is a dangerous position. First, it undermines central bank independence. When monetary policy becomes a tool of political financing, credibility suffers. Investors start questioning whether inflation is being tolerated to finance deficits. That can trigger bond market sell-offs, higher yields, and debt spirals. Second, fiscal dominance distorts economic signals. In normal times, interest rates reflect the cost of capital and risk. But if rates are artificially suppressed, capital misallocation occurs. Zombie companies survive. Real productivity declines. Third, it erodes public trust. Citizens see inflation rising while wages stagnate. They hear central bankers speak of transitory forces while food, rent, and fuel costs surge. They begin to suspect that the system is not broken, it's rigged. The UK faced a mini-crisis in 2022 when the Bank of England had to intervene to stabilise pension funds after a botched fiscal plan. In Japan, the Bank of Japan now owns over 50% of the government bond market. In the US, the Fed holds over $8 trillion in assets and is increasingly politicized. Monetary policy is being cornered. Rate hikes risk fiscal explosions. Asset sales threaten market turmoil. Doing nothing invites inflation. We're approaching a point where the traditional roles of central banks and treasuries are blurred. Monetary independence was a 20th century innovation. Fiscal dominance may be a 21st century reality. The implications are profound. Bond markets could lose their anchor, inflation expectations may unmoor, and central banks may find themselves tools of political necessity rather than guardians of stability. In this environment, the search for new solutions is intensifying. And that's where we head next. Chapter 3: The Search for New Solutions. As the old playbook fails, radical ideas once confined to economic think tanks are moving into the mainstream. Central banks are exploring novel tools, not because they want to, but because they have to. At the center of this experimentation is the concept of central bank digital currencies, CBDCs. Unlike cryptocurrencies, which are decentralized and volatile, CBDCs are sovereign, programmable, and traceable. They offer central banks a direct line to citizens. With CBDCs, governments could inject money into digital wallets instantly. They could set expiration dates on stimulus funds to encourage spending. They could target specific sectors or demographics. In theory, this allows for ultra-precise monetary policy. But the risks are enormous. CBDCs could enable surveillance at an unprecedented scale. Every transaction could be logged. Spending limits could be imposed. Access to money could be conditioned on social behavior. The power to issue, direct, and restrict money would shift from private banks to the state. Alongside CBDCs, Modern monetary theory, MMT, has gained traction. MMT argues that governments can spend freely in their own currency, with inflation, not debt, being the constraint. While appealing in theory, MMT relies on an immense degree of political discipline that history suggests is unlikely. Other proposals include dual interest rates, different rates for loans and deposits, People's QE, central banks funding green or social projects, and direct fiscal monetary coordination. All these reflect a broader trend. Central banks are no longer neutral referees. They are becoming active players in a game where the rules are changing. As trust in fiat currency wavers, even alternatives like gold and Bitcoin are returning to prominence. The very idea of what money is and who controls it is being questioned. We are entering a financial era where the old boundaries are dissolving. And as the center shifts, so does the future. Conclusion: a world after central banks. We are at the edge of a monetary transformation. For much of the last century, central banks stood as pillars of stability. Their power was rooted in credibility, independence, and the effectiveness of their tools. But those tools, interest rates, QE, forward guidance, are losing power. Inflation is back. Debt is massive. Politics is polarized. And trust is eroding. As central banks exhaust their traditional ammo, the world must confront uncomfortable questions: who now controls the money supply? Can fiat currencies maintain value in an era of fiscal dominance? Will citizens accept programmable digital cash? Will inflation become the new norm? What comes next may be messy. Expect more financial volatility. Expect experimentation. Expect pushback from citizens concerned about privacy, autonomy, and economic justice. Yet in crisis, there is opportunity. This could be the moment to redesign the monetary system for the 21st century, more resilient, more inclusive, and less prone to crisis. But it will require honesty. It will require courage. And it will require letting go of the illusion that central banks can fix everything. The next chapter in the global economy is being written. And the pen is no longer in central banks' hands. Stay curious, stay informed, and subscribe to Money Minded for more insights like this.